What's up, Investor Nation? The boys are back from iFund Cities with our January market update. We just wanted to say and hope everybody had a good holiday season and a happy new year. But there's no rest for the weak and weary. We're here with the capital markets boys, Bryan and Jack. We're excited to give you some information today. I will say it's going to be light a little bit on the statistics. Not a lot of data out yet. We're anticipating some stuff coming. We're going to be giving more information, in February, March. But we'll do our best to recap 2024, give you a forecast for 25, talk a little interest rates, and then most importantly, we're going to give you some lessons from some of the mistakes we've seen over $2 billion in loans. So with that, we'll kick it off. JD, let's talk interest rates, my boy.
Yeah. So just want to reiterate, Happy New Year to everybody. It was a great 2024 and looking forward to 2025. Like Ryan alluded to, not a ton of data to go over, but we still got to touch on our favorite topic, interest rates, as always. So on the chart, you'll see here, we covered sort of the 75 basis points of cuts in September and November. And then our last meeting was right before the December Fed meeting. We got an additional 25 basis point cut. No surprise, right? The market had that as like a 99% probability. Fed had to do it to avoid spooking the market. So they did. And so all in all, from September through the end of 2024, we saw 100 basis points. But like you guys all felt and we all noticed, the 10-year actually went in the opposite direction in the same magnitude. So we saw the 10-year sort of bottom out around 3.5% in late September and then rise all the way up to where it is now at about 460. So 100 basis points of cuts, but 100 basis points of a 10-year increase. The one thing I do want to note on this slide is you'll see that gap between the 2 and 10-year really start to widen out as we hit December and moving into January. If you look before December, you'll see those lines are really in lockstep at a pretty tight spread. But we really saw that spread sort of blow out. Now it's about 40 basis points where we are today, and that sort of signifies like a normalizing of the yield curve, a steepening of the yield curve that's more normal to sort of historical levels. And I think what that brings is stability for investors and market participants. And I think we've started to see, with our investors, them get comfortable around where the 10-year is and start to see some more, where they were waiting maybe to refinance because they were banking on lower interest rates. We start to see some activity pick up now that everybody's like, okay, it's stable. This is sort of where we are for the time being.
Our boy is getting good. Let's go, JD. Nice. Bryan, what would you add?
No, I think there's only one takeaway I think really from this chart is that confidence. That gap is the growth.
Yep.
So there's more confidence, and the 10-year, which is the longer duration, the longer term interest rates higher now than the 2-year. That there's more confidence around the growth, and so it's refreshing. It feels a little refreshing. So you're not feeling it in your interest, in your borrowing costs right now. But I could tell you, it's a positive sentiment. It's a positive move. It's positive going into this year.
Forward guidance. I see next Fed meeting here, 28th, 29th. JD, what's the dot plot saying?
Yeah, so I think market right now is in agreement with sort of what the Fed governors have been saying, and that's no rate cuts until maybe June, and then maybe get 2 or 3 for the total of 2025. But again, no rate cuts till June. That's again tying into that stability that we're starting to see. Yeah, that certainty that really makes market participants and investors feel comfortable.
They can put a price tag on what their WAC's is going to be, their weighted cost of capital is going to be. Bryan, anything you add there?
No, just that maybe we'll see. So we saw the Fed cut and rates shot higher. So now the Feds won't cut for the next 6 months. Maybe we'll see rates decline. I don't know. Exactly. I don't know. So we'll see.
All right, moving on to the second topic, unemployment and inflation. Bryan, why don't you kick us off on this one?
Yep. So we've got so we did see the unemployment rate tick down, and so you did see rates shot up. Mm-hmm. Unemployment, was pretty solid in the month of December. Came out in January. It feels like the labor market. We've talked about it in December and November. It feels like we're chugging along, and there's not any kind of macro events. I think things we'll be watching this year are how does so Trump gets in office on Monday of this week. How does some of his executive orders? They've talked about the IRS. He's talked about bringing back the workers into the office. Some of these actions, does that start to ripple into some of this public sector unemployment? I don't know, but
it was interesting. Elon revised his Doge analysis, saying I forget it was like $2 billion or whatever it was, down to $1 billion in terms of savings and efficiency, as he's been spending some time digging in.
Yeah, it's funny though because I think he just has a mandate to cut some government workers. So we'll see. We'll see what happens with unemployment.
Yeah.
Anything else, boys, to note here that's important? In line, right?
Yeah, I mean,
general sentiment's in line.
Yeah, the only other thing that is, so it felt like rates were like in this, they were moving higher at a hell of a lot faster than it felt good in the month of January. And then we got the inflation report came out in the middle of the month, and that like calmed everybody down. It was like, I don't know if the market was expecting something, some outlier of data, something that they thought was going to make this report hot, but it came in actually below expectations, and everybody's like, was able to come back to earth and felt a hell of a lot more.
Well, if you read all the retail reports, right, it was like spend during the holiday season. I think everybody was anticipating, like you said, a bloated print, and it didn't, and it's like, oh God.
Yeah. So
God bless.
We're
back. We're back. All right. So we're going to move right into the 2024 recap. Year standoff. So this is largely geared towards a little bit of multifamily, but limited activity transactions. So super low transactions. The why behind that, right? I think Jack just alluded to. There's no certainty. They couldn't pencil where their cost of capital was going to be. It was a moving target. It was a lot of volatility, right? That I drove a lot of standoffs on where guys can buy projects, in addition to sellers not wanting to capitulate and take lower prices. I think that's an interesting thing. Supply overhang, if you were in multi, they had a huge glut of supply come on. I think they were actually, as you heard us talk about, I think in November, we talked multi, right? And actually the retention in the beds was pretty good. We actually absorbed the supply really well, which was a nice thing. And then this looming, we heard a conversation with Barcadia CEO, and he talks about the wall of maturities, right? And we haven't seen that. We've seen a lot of banks pretend and extend or work with sponsors. And it was interesting because if you're a bank and you have a good sponsor on the other side, why do you want to foreclose to go trade it to another sponsor? I think you're more apt or tuned to work with your current sponsor than go through all the headache than it is to retrade the asset when it's going to be underperforming while you have it on your books. You don't want to manage those assets. And so we've seen that. So the question is, in 25, does some of this come due? And do we see some kind of distressed transactions happen? Boys, what do we think?
Yeah, so I think the maturity. So I think there's a couple different ways that it'll be interesting how some of this plays out. So you've got the real estate side and then the business side. So you've got private equity. So the maturities just doesn't relate. The maturities just doesn't relate to real estate and real estate transactions. You also have a lot of private equity deals that have debt. They bought. They bought the H. They've got the HVAC company that they bought, assuming that they could keep refinancing or highly leveraged different business accounting firms. The stories, and so it'll be interesting to see if some of that that's definitely some supply that'll have to get dealt with, of whether or not that debt service can cover the higher rate where we're at now. I would, you'll see. I think you'll see a lot of institutions continue to work through it, so that they don't have to trade, they don't have to mark down their books. It feels like similar to like the multifamily, that there isn't like it isn't like the top line of the businesses are coming down. It isn't like wages are like significantly coming or rents are significantly coming down. It's really just a rate issue. So maybe the quality of the asset, the quality of the business, the quality of the property is going to allow everybody the justification of like, all right, let's continue to work through this at a slower pace.
Yep.
That'd be my take.
We got some positive headwinds too, right? You got wages outpacing rents, right?
Yep.
Which I think was good. You get some rent compression in the lower class. I mean, listening to the Barcadia CEO was interesting. He was like, all the major institutions trading or chasing, Class A, Class B, and your B minus and your C being like kind of an interesting opportunity for local operators that we might support. There's not an institutional market for that asset class at scale, and so it tends to be a local operated asset class. So it could be some cool opportunities for smaller operators, which we haven't seen in a while, which would be good, right? And then I thought was another interesting fact was large SFR operators kind of moving to this BTR community, which is interesting.
Yeah, you definitely saw that last year. You definitely saw the movements into this build to rent kind of. And what's interesting about that strategy is it probably gives that operator a little bit of flexibility where they were used to buying. Here's all these single family properties
Scattered.
Yeah, scattered single family properties. Now they own all these places. If it didn't work for whatever reason, something happened, they might have the ability to sell out the individual. So it's like kind of a diversifying strategy. Seems pretty intuitive, but definitely, it'll be good.
Oh, go ahead, hit it.
It was I think definitely what's like what you mentioned around the lower class property, like institutional investors all think alike. It's like they all read the same research and like they all, so that hurt. That's right. That's right. That's right. And so they're all moving in the same direction. And so, for our customers out there, that's where the opportunity is going to be.
Love it. So. And then the Northeast, man, Northeast and Midwest representing Philly. Like the Northeast held strong, right? Undersupplied, demand stays high, and then you see some hiccups in the Sun Belt. Yeah. Although I think as a team, we're bullish on the Sun Belt for migration patterns and household formation where jobs are growing. And then we want to say else about 2024. Let's get into 20.
Yeah, it's in the rearview mirror.
Sweet.
Yeah.
Kick us off, Bryan, on 2025. What are we thinking?
All right. So why don't you give a little bit? So we were just in New York.
Yep.
Yesterday, it was freezing. And so it was super cold, but we had a great set of meetings.
Yep.
Why don't you give some of the color before we get into some of this? Because I think it'll play into some of the themes. Why don't you give a little bit of color on some of the thoughts that we had from those meetings?
Yeah, I mean, I think the overall sentiment, if you're a lender in the residential transition loan space or DSCR space, or you're in that food group, that there's going to be capital inflows into that space, right? And probably more. There's going to be legacy entrants or legacy players are still there, right, and are growing, and then new entrants are coming in. And so if you're a borrower, I think it's going to be a really interesting time to talk to multiple lenders and see what appetite their capital has, and talk to, diversify your lending strategy. I'd say at the top of the food group, your Goldmans, your JPMs, they're starting to get interested in the asset classes. So it's no longer just your private equity companies and your smaller mid-sized funds. It's now the big boys are looking at it going, all right, this thing's mature. It's got good track record. It's got good history. Like, I'm interested. How do I enter? Am I going to finance lenders? Am I going to buy whole loans? Am I going to be an issuer of securitization? Am I going to do all three? And I think we left going, it's an exciting asset class, and it's almost like what's that movie from The Big Short, where Michael Burry's in there doing the trade early, and we're sitting at JPM, and we're like, wow, we're like at ground zero of this thing happening with their securitization desk, like quizzing us on what's the market size and how much we can deliver. So I think Bryan and I left super excited about where the space is headed. And for a borrower, you should be absolutely excited about the liquidity that's coming to the space and how you can access it.
Yeah, I mean, it went from the phone calls that we had 6 years ago were, what do you guys do? Like, what? They're like, what is this? Explain this. To, we don't, like a year later, it's, we don't do that. And then it's like, all right, so how are you guys performing? Who are you guys selling to? Now it's like, all right, now we're ready to put our toe in. But that's how those institutions move. It's slow. And so I think that was an important part for the 2025 outlook. Now we can get into this slide is like, so rates are higher. There's still affordability constraints. We think that's a common theme. That's going to be the theme.
Yep.
They're higher rates are hindering that. But there's increased certainty around where interest rates are going to be. So maybe somewhere between 4 and 5%. There's some confidence that we're not going dramatically into one area or another. We've got an administration now in place, so that uncertainty of who's going to be president, who's going to be running certain aspects of the country. So that's now a certainty. We've got, so the oversupply that's come out of like Florida, Texas, Florida, some of the areas in the other areas in the Sun Belt. It feels like the general theme is like that might be a short-term blip. There's been a slowdown, like just because rates jacked up so much higher, there's still been a slowdown in construction, so that supply is going to get absorbed. And there's a lot of dry powder. I think there's a lot of dry powder.
Man.
Yep. And we see that all day long in our space with the investors that we're talking, the counterparties, the capital markets that we're talking to. They're definitely long cash and they need to deploy it, or folks behind them are long cash, and so there's a lot of pent up cash that's looking for a home, and it needs to once it finds its home into certain like things that feel pretty good, it feels pretty certain. And then the last thing on the list is the outlook, which is an area that we follow closely as home builders, and they're aggressively purchasing it. So think of the nationals, think of the NVRs, the DR Hortons, and these folks are they're gobbling up land as fast as they can, and so they're going to be a big component of that new construction, new land development.
It does feel like residential real estate is being institutionalized, and 2025 could be the year of big institutions doing deals, right? Whether it's the national builders or the big multifamily operators. And I do think if you're a small local operator, you're going to have to figure out how to compete. And that Class CB, I think, is in undersupplied markets is going to be really interesting opportunity for these guys.
And some of the infill lots.
Correct.
Right?
Yeah. I think you're going to see them naturally gravitate towards infill.
Yeah.
And if you can do really well there, I think that's going to be an interesting opportunity. JD, anything you'd add? I know you listened to a call yesterday, and I thought it was kind of interesting what you summarized for me yesterday.
I listened to the DR Horton earnings call yesterday, and I thought it was interesting. Like their inventory's down, but it's sort of down on purpose to match what they've sort of got in the pipeline as far as sales go. And it was interesting. Like their revenues were down. All the positive metrics seemed to be down, but they still beat their earnings. I think because of that new sort of inventory matching. What's really in their pipeline, making sure they're not oversupplied on inventory. And then they also just stock repurchase, which always helps. But overall, like positive, and they did harp on the fact, the aggressively purchasing land. So, even though maybe the sort of interest rates longer for higher hindered their business a little bit, it was still super positive for 2025.
Stock repurchase typically, though, means in a company they don't have anything to do with their cash, right? They're uncertain, and they're kind of like walking into the uncertainty a little bit with a steady hand. So it sounds like that could be an interesting thing to look out for. Cool. Yeah. Anything on 2025, guys, other than that?
It's going to be a good year, man. I think it's going to be a good, interesting year, a good transition year as folks kind of work through the supply and pretty bullish in the space.
All right, this is one we've been wanting to do, and it's going to have some negativity and some positivity to it. I think it's important, right? Because we've seen this now. We've worked through a lot of loans that have had issues or maturity issues or structural issues, and so I think it's. When you listen to this, keep this in mind that we're trying to be helpful over 4,000 loans, and that we're not trying to be doom and gloom. So I think, Bryan, you look at a lot of the loans that come through the organization. I think you should kick us off with some of the key issues. The first one's definitely keen to many borrowers in the space.
Yeah, absolutely. So without being too negative, I guess. Here's the top things that we look at where folks have struggled. And so use this as, the lessons learned from iFund Cities. All right, so scaling. Real estate, so we look at experience. We look at somebody's ability to, so you're using leverage in order to grow your business.
Yep.
And so that's a tool. It's positive. Real estate typically needs some type of leverage to make the profile want to be advantageous. And so we see borrowers that might get too aggressive. The first project goes great. The second project, now they're ready to go. And they might not have the systems, the processes in place, the capital. Like if you did everything in cash, you hit the lottery and you bought everything cash, you're kind of like, I'll just keep working through it and throw money at the problem. But when you're borrowing money, scaling can cause you to go the opposite direction. And so take it slow. Focus on those systems, focus on those processes, learn from others so that you're not making the same mistakes that others that have scaled successfully. Everybody kind of makes the same, it feels like, makes the same mistakes.
Yep.
And so you could probably learn from others pretty quickly. So take the advice. Don't be afraid to ask the questions. I'm sure they've all failed in one respect that you might, or one hurdle has come up. And so scaling's definitely been.
And when your cost of capital is ticking on your scale, right, and you got a bird in hand, you got an offer, and it's $25,000 less than you thought, and you're making 75 instead of 100, or 50 instead of 75, or 25 instead of 50, or 0. We've seen way too many operators continue to punt. Interest rates are going to come down, and that default interest or those maturity, extension fees start to eat your profit away. Your LPs get impatient, and it causes this ripple effect. I think the biggest thing we could take away from 21, 22 vintage for guys with us is like hit the bid, return the capital. The velocity of capital is what's going to actually keep you in the business than it is making an extra $10,000 on a property.
That's right.
100%.
That's right.
LP capital issues. This is one I think that we weren't really keen on, and we've had a couple big deals go south due to this, and this has become a huge focus of our attention now in underwriting.
That's right. So folks raise capital. They do a general partner sits at the top, a limited partner sits at the bottom, and you go out and you raise capital either into that structure or you just bring in members or however you're raising capital into a deal, and it's become more mainstream. And we think it's going to continue is that retail investors pump money into these transactions. And so what ends up happening is you raise capital for a transaction, and then the city delays something, and now the market maybe moved a little bit, and now you can't exactly sell the project for $500,000. You got to sell it for $450,000, or something changes. When you, as a GP-LP relationship, one of the things we are spending more time in is diving into that operating agreement to understand what controls you have as the general partner, our borrower, and against your limited partners or your capital sources. Because think about now you're negotiating a year or 2 years, some point in the future with your LPs because you need them to bring in more capital. And so depending upon the project, you're negotiating from a point of weakness. Yep. I don't know another way to say it, but you're negotiating from a point of weakness because you need their money or all hell could break loose. And so we would want to make sure, and you should make sure, you've got all that capital called in the beginning. You want the capital, you want it up front. That covers your interest payments, that covers contingencies, that covers, I need to go stage the property, yep. I need to do whatever it might need to do. You want to pull in all that capital up front so that you're not negotiating something different in 12 to 18 months.
That's right. Anticipation of capital is key, right? Because if your project's not performing, you're calling capital, your LP's coming back for all of it, right?
Yep.
Your child, your firstborn child, and you're going, I got to maintain some yield in there. And so not only are you negotiating with your lender, you're now negotiating with your LP partner, right? And now we're all together doing a dance, and it slows the whole process down.
Yeah, that's right.
Project delays. This one is so important. If you build anything, if you take anything away, you must have a good zoning attorney, or you must understand your zoning regulations and ordinance and where you invest. Like, we see this all the time. We're going to get permits in 3 weeks. You're going to get permits in 6 months, right? And so it destroys your project, and it slows everything down. Hurts your LP, hurts your profitability if you raise the capital, and your lender's going to be pissed off and you're paying extension fees. So I think it's really, 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 really important to understand where you're investing and what the process is to get building permits.
Yeah, I mean, well said.
All right. Higher for longer sensitivity tested.
So I'd group the next two into like, all right, so higher for longer and have a backup plan. That gets into this like, if you can't sell the property, and this worked really well for us in Florida, where they were just like Ocala's and the Cape Corals and LaBelle and Lehigh Acres, they weren't able to sell the properties fast enough where they could just hold the property, get a good rent in there. The rent income was phenomenal.
Yep.
Rent income was phenomenal. And so having that ability to have a backup strategy where they were comfortable owning it. They had the property management. They already owned other properties there. They probably would have liked to sell it, but they had the fallback strategy. And we've seen that time and time again where it's important to, you're not relying on interest rates to go from 6%, 7% down to 4%. You're comfortable at those levels or you're comfortable higher. It doesn't make the project, it doesn't destroy your project because what rates are doing or that you have to hold it longer.
Yeah, I think that's how you sort of like level up your game as an investor, right? Is being prepared for those scenarios, and again, that's like that's how you help yourself scale, at a constant but steady pace in the right direction. So,
location. This is like the age-old 101 of real estate, transit-oriented, good school districts. But if you are stretching, I think it's really important if you're stretching into tertiary, even infill, that you pay attention to what you're building, right? And so although we have low supply, lipstick on a pig isn't going to work in these interest rate environments, right? And then more importantly, overbuilding in a terrible neighborhood isn't going to give you the higher yield. And so I really think you got to pay attention to your location and your strategy if you're stretching out into other communities and to what you want to, what you're building and how you're building, and trying to make something that's going to meet the market versus make the market. We've seen a lot of guys stretch to make the market and they're getting hammered.
That's right. That's right. Be careful. Look look around the area. You're across from a cemetery. You're across from power lines. You got to look at you got to be sensitive to that location. Even though appraisals come back and sometimes they're not. They don't they always don't do the best job. But look at some of those intangibles that pop up with the location.
Bryan loves the last one. If you're a Burr operator with a 600 credit score, what happens to you, Bryan?
Yeah. The Burr. We're gonna spend some time on the Burr this year. But that's right. And so know your credit score. It's important. Like I know, like 2020, probably like 2016, 2015, like there was a lot of companies out there like saying, yeah, your credit score doesn't matter. Your credit score doesn't matter.
Subprime days.
Yeah. Yeah. And they're like, oh, it's just a number. It's just this. I mean, it is, I could tell you at the institutional level, which is a lot of the smart money, they're looking at it. They're looking at it. And so sometimes we don't know why something changes in the credit score, but, know it, understand it, pay attention to it. Like it's just an important component, and it helps for the multiple exits when you can get lower financing costs in this space, kind of regardless,
or maximize profit.
Or
if you're scaling a real estate organization, you have a bad credit score, and you're trying to maximize cash out of your property, you are going to struggle. So you're going to have the ability to raise more capital, or you're going to be leaving capital in. Your LPs are staying in the deal. Like, you got to have a 700 FICO score. It's an indication of how you pay your bills, right? And the institutions, the quote unquote smart money, the spreadsheets and run other people's money, thinks a lot about it, because it is a good indicator when you look at the historical. I'm messing with Wall Street, but if you look at the historical data, it makes an impact, and you see defaults below 680. Right. And that's kind of the threshold. So if you're not 680 to 750, you're going to struggle, right, I think, to scale in this business. And the institutions are hip to, oh, my buddy Bryan's got an 800 and my buddy Ryan's got a 600. Let me just use Bryan's credit score. Like, they're getting hip to that because, it's back to that GPLP, the conversation and what happens when Bryan's credit score drops. Right. So I think you got to pay attention.
That's right.
And I feel like I see it all the time.
Yeah. Yep. That's a good one.
Yeah. There's just, strong correlation between your credit score and between credit scores and loan delinquencies. And so Wall Street cares about it. We got to care about it. So you should care about it.
That's right.
Yeah.
That's right.
I've got one more that
Look,
I
he's
know.
got the outlier. He's thinking over there.
One more I got to add to this list. Know who you're buying the property from.
Yeah. Chain of custody.
Good one. Yeah.
Know who you're buying it from. We live in a capitalistic society, and so typically, if somebody has the opportunity to make money on the transaction, as much as I like Jack and Ryan, I might want to keep the property myself, or at least the probability that I'm going to keep the property myself and sell it. It was like, no, let me give this over to Jack, and he's going to go sell it. Or give it over to Ryan, and he's going to go sell it. It just typically doesn't happen that way. I know there's a lot of good people out there. I'm certain that, but pay attention to who you're buying the property from and why they want to sell it. I think it's an important lesson that we've
I agree.
we've learned.
You should definitely buy from me. I'm nicer than Jack. Jack's taking all the profits.
Right.
I might be like, oh, it's okay. All right, here we go. We're moving on. All right, how can we help? I think this is important. We're going to put a big emphasis on supporting investors. We want to be a resource. That's why we started this market update. So if you have projects and you want our help underwriting, we should do that. If you want timeline reviews, we've done a bunch of deals across the spectrum now, including some big land for national guys. And so I think we have a really good understanding of kind of how those timelines work. Market analysis, we can help you with the data we can pull, right? And then credit analysis, you got two of the smartest and brightest credit minds in the game here at RTL. And so we can, they're the smart money from Wall Street. And they can help you crank that out. But fellas, anything I missed or add here?
Reach out to your local loan officer.
Heck yeah.
Yeah, we got a
For
great
help on
team.
this
We
stuff.
spend a lot, like this. Everybody in the company spends a lot of time and effort working with the teams. The whether you interface with our account managers, our loan officers, whatever title they may have, we spend a lot of time on the training and making sure folks are educated. And we got a lot of resources. Sometimes it might not make it all the way to you, but reach out to our team and we'll be able to help.
All right, guys, we're going to move over to Q&A here. JD, why don't you kick us off with the Q&A? How's your underwriting team evaluate interest rate sensitivity? How does the stress test affect what metrics you guys get comfortable with from a DSCR standpoint?
Yeah, I think like going back to what Bryan was talking about, where maybe your plan is to sell, but you don't get the bid that you want, and so now you're looking at a refi. So what we can do is, we can run sort of hypothetical scenarios around like a refinance, run different interest rates and get sort of comfortability around how well the property is going to cash flow against different interest rate environments. That way you can feel certainty around, all right, if I can't sell it, and say rates remain high, I can't sell it because there's still sort of an unaffordability piece. Well, at least I know that I can rent this property out and it'll cash flow against my debt service at a given interest rate. Yeah.
Yeah, the only other thing I'd add is like our models will go and look at, all right, that 10 unit current cash flows, maybe it's 115 DSCR, and then what after these improvements are made, here's what the pro forma dictates, and now it jumps up to 1.3, or maybe it's on the borderline, maybe it's like 1.2. It's not that big of an improvement, and so we'll look at compensating factors that say, all right, what's the track record? Has the borrower gone through and executed on a project like this? Do we think if we use interest rates that are 50 bips higher than they are today, does it still work at maybe at a 1.15? So we'll look at compensating factors, experience, credit scores, the project itself, to be able to determine what variability we want to accept when we're underwriting a deal.
Question 2, what do we think about the 2025 kind of new issuance of securitization? I think it's going to be the year of new issuance and rated issuance in the space, right? So we saw a few last year. I think you're going to see more this year. It's sixes right now between the insurance capital and securitizations on what makes sense, but I think you're going to have both pockets of capital, lenders accessing both, and I think what that ultimately means to a borrower is additional liquidity and optionality on who your lender could be and what potential programs they could provide.
I think that diversification's key. You're going to sometimes see securitizations going to get a little bit tighter versus other types of capital, insurance type of capital. Securitizations feel like they're growing. Ryan mentioned into this year, but diversification, which we have an enormous amount of, is what that's the reason we've got diversification in the platform.
I think what you'll see with the issuance is the guys that really do issuance, you're going to see them bolster up and really get aggressive when they have to fill up a securitization, and then they'll back off. It kind of normalizes the market. We've seen that over the last couple of years. And I think if I'm a borrower, one of the questions I want to ask my lender is, what does your capital stack look like? If you're 100% reliant on securitizations and something happens to capital markets, you may be stuck. So I do think having a lender that has a balance sheet, the ability to hold your loan for maturity, has the sophistication to enter the securitization market and the ability to place into insurance capital, that diversification is really what's going to give your lender stability and who you want to be working with when you're picking a lender.
That's right.
I love Eric's question, but it's shout out to JD. So how's that book, brother?
Yeah. I should start reading
it. It's number one on the, it's top 10 Amazon.
Yeah, it's worked so far.
So you got to read off the question.
Eric asked JD, is that AJ Brown's copy of Inner Excellence on the table there? The book that he likes to read mid-game. It's working, so that's all that matters.
What's the general criteria for ground-up new construction for the purpose of either resale or renting, Bryan?
So for purpose of either resale or renting, I mean, so I love using extreme examples. So we had a project float by our desk where it was like a $3 million build for a place in Miami in a residential neighborhood. And so that's a pure retail type play for us. And so we would look at it as a retail. You're our resale versus renting it out. We're gonna look at the rental analysis. Probably is not gonna make a lot of sense, but we're gonna look at the area. And so for the resale stuff, it's how many places around that little area have sold for $2 to $3 million. Is there new construction in the area? When you get in the renting side, we're gonna look at the same type of thing. What are you building for that rental product? It's gonna carry a lower. If you're building it for rent, your finishes are gonna be less, and so you'll probably be at a lower price per square foot. We'll see what That's where we're gonna really focus on the DSCR calculations. What's your credit score? Have you executed? Who's going to be managing the property? How are you going to get it leased up? That type of process in order to get it cash flowing, because the faster you get it cash flowing, you're going to get it. That's where you get into the stabilized loans and you're kind of moving on from a negative cash flowing asset property.
Anything to
add? Yeah, I guess I would just add, and on the resale side of things, like we're really focused on sort of the metrics of that market. So looking at Zillow data, making sure like values are appreciating, houses are moving, they're not sitting for a while. And then, to Bryan's point, on the renting side, not as important that you hit those metrics, but it is really important that we're modeling like a strong cash flow for the property.
With DR Horton being asset light, do you see that as a downside? Inventory is not rolling off. So they're not asset light. They got 25% on their balance sheet. Then they own another off balance sheet lender that they own 40 to 60%. That equates to 50% of their inventory roughly being on their balance sheet and the rest being off balance sheet with land banking partners. I think if DR is starting to see some slowdowns and you're a new home builder, like you should be paying attention, right? They build at a historically low cost compared to most other builders, but they were off nominal amounts here. They weren't off significant. I will also say they have a better strategy than most regional builders or smaller builders because they can buy down mortgage rates. And so their inventory is going to move faster. If you start to see that across the top 10, I think you got to start paying attention. And if they dominate your market and they're not seeing velocity, so in production housing, they should see 3 to 4 homes move a month. And then on luxury housing, 800,000 to $1.5 million, they want to see 1 to 2 a month in the market, that specific market. If you're starting to see that stuff slow down, you should pay attention to what you're building.
Yeah, I think, and just to add, like, I don't think you should view it as a downside with just when you're just thinking about them, like you think about their level of expertise and track record and how long they've been in the game. Like they just, tweaked their business plan a little bit to deal with sort of, some hindered demand with the unaffordability piece. So they're really I think just trying to, make the best with what they were dealt with and just tweak the business plan a little bit. I wouldn't, view it as a total downside across the whole industry.
I agree.
No, I think that's spot on. That's good.
What do you think about SFR shifting to more affordable options, like manufactured homes at mass scale, places like Georgia and other places that are struggling to provide homes fast enough? I think I'll take this one first. I think we're hoping that the new regime in the White House will hopefully reduce some of the regulatory issues at state and local levels to free up the timelines for permits to hopefully start to get more inventory going. I think we also need rates to come in to kind of unlock it. You've heard us talk about in October, November, that theory needs to come down. Manufactured housing, tough for lenders like us because it's a proven model. There's not that much liquidity out there for it. And in general, I think we can't inspect the property. So it's really, really hard if you don't have a lot of cash as an investor to do it at scale. Although we think it's an interesting product. That would be kind of my take on affordable housing.
Yeah, I mean, I think it's this is the reason that the home builders are as bullish. I think as bullish as they are. They, maybe it's throttled back a little bit, but they're continuing to build. They're building at pretty aggressive prices per square foot. Yep. They do the buy down of the mortgages, but I think what you would see before manufacturing homes is probably like less square foot houses, maybe, than to address affordability versus anything else is what I'd say.
Do you guys operate in the 100 to 300K range? Yeah, absolutely. Our minimum loan size is 75. We'd love to be in that price point all day long, especially if it's a good kind of growing market segment. And then the last question, how do you guys feel about 3D printing homes? I'm sure that technology is fast-paced and moving forward. I don't know that we're an expert here to opine on 3D homes. Maybe someday, but right now we're stick build. Stick build experts, so we appreciate it. All right, guys, that's it for the questions. We appreciate you tuning in. We'll see you back in February with hopefully some more market news and some more data around how we think 25 is going to shake out, and definitely a segment from Bryan on the Burr.
Oh, excited.
See you guys.